Straight to the floor show with that and our traders, Thomas Hayes and Scott Shellady. Tom, any chance this is all tough talk by the Fed?
Yeah, I think as we talked about last week, Lauren, this is, talk hawkish, act dovish. It's a continuation. And this strategy has proven extremely effective when you look at 5-year forward break-even inflation rates, which the Fed is mostly focused on. They're at 2.71%. So they're going to continue this. The most important numbers this month are not the jobs report everyone's worried about since the JOLTS report this morning. It's the PPI and CPI that comes out on the 13th and 14th, which Fed President Bostic said today if that comes in a little bit lighter, maybe the Fed goes a little bit lighter on the rate hike. So I think we've just got to wait a week and a half in this limbo. We'll see the jobs report on Friday. It's expected to be strong. The JOLTS report was strong. Yep. But like last month, focus on the inflation numbers. And
we get those CPI numbers, like you said, Tom. Scott, I was looking at this consumer confidence gangbusters report for August. I mean, what gives? Yes, gas prices have come down from their record highs just a few weeks ago, but is that the reason why those planning to take a vacation in 6 months hits an 8-month high? Our purchases of durable goods, those big expensive items, that's up too? I mean, are we not being influenced by inflation?
Oh, I think they are, but I think that they were looking for any bit of good news. And any bit of good news, they celebrated in a short-term good mood. And I view those numbers just like I viewed the bear market rally we just had. Scratching my head like, what gives? But people kind of felt good. They felt better about their situations. That's when we had those numbers taken. And so let them have a little bit of happiness, because I think what's in front of them is a lot of pain. Like we said earlier, the Fed is going to raise interest rates. The Fed is going to raise the unemployment rate. Now, if we have any type of inflation when it comes to energy, that means we have energy inflation. At the same time, we've got food, fuel, and shelter going up. I don't like what that's saying to me here. So that means I feel like we still have some aggressive rate hikes in front of us. However, we will overshoot. We will overshoot. They always do. But then we're going to have to dial things back with maybe a cut sometime next year. But right now, I think that they're emboldened. They're on this rate hike path, and they're angry. They want to get some of their credibility back. So they're going to hike until it's too late, and then they'll start to dial back.
So the post-Powell pain persists, Tom. I worked on that, 4 Ps in a row. What are the chances? Yeah, there's going to be a slowdown. Maybe we're in a recession, headed for a recession, however you want to define it. How bad is it going to be?
Well, look, it's natural to have consolidation in the market after you've had a huge move off the June lows. The put-call ratio is now 122. People are buying insurance after the house is on fire, as they usually do. So this points to we're probably going to consolidate for maybe a little bit time longer. But I think the path of least resistance as we look out a few months is going to be higher. This has served up a temporary opportunity to look at buying high-quality businesses at a discount on this pullback, on these Fed fears. And the recession, we've had the 2 quarters of negative GDP growth. As a matter of fact, recession fears today are the highest since April of 2020 and March of 2009. Those were lows. Those were periods when you wanted to be a buyer, not a seller. And that's where sentiment is right now. And everyone continues to look in the rearview mirror versus looking forward. Analysts were looking for earnings estimates to come down 20% in Q2. They came down 2%. This market is holding up. This economy is holding up in the face of a lot of different headwinds. And I think as we move forward and you buy quality that's been marked down, you're going to do very well looking 12 to 24 months out.
Speaking of quality marked down, big tech. I mean, if you look at Apple, if you look at Microsoft, down 2% just, in this young week. Scott, is that going to be, is this the opportunity to buy? Or do you see new leadership in the market?
No, I still love big tech because, with one line of code, they can save 1 million people, right? But it's still not the right time for the line of code. I still feel as though, yes, whatever time of the year you buy this market today or tomorrow or next month, in a 20-year period, you're going to do very, very well, right? But I still think in the short term, we have some ugliness ahead of us, and you're going to get a better chance to buy those big tech names between now and, say, Thanksgiving. So keep that powder dry. And also, I think you should be in energy, too. We're not getting rid of fossil fuels, folks. So I would stay with big tech, and I would stick with fossil fuel, but you're just going to get a better a chance to buy them between now and Thanksgiving.
Yeah, not to mention, if we get one bad hurricane in the Gulf of Mexico, whoop, up goes the price of oil and gas. Scott Shelley, Tom Hayes, thank you very much. And did you guys
Thanks,
see
Lauren.
this report?